I was around when Ethereum had its ICO. I had the opportunity to buy Ethereum at, I believe, 13 cents, but I didn't understand that it didn't just do what Bitcoin did. And so I opted to not buy Ethereum at 13 cents. I didn't buy Ethereum until much later when I actually understood what it did. Welcome to the Blockhead Podcast, where we share the most unpopular opinions in crypto. My name is Doug, and today we're not really sharing an opinion, but I do want to clear up something that is greatly misunderstood in crypto today, even in 2024. And that is the difference between what Bitcoin does and what Ethereum does. All right. And this doesn't just apply to Bitcoin and Ethereum, but really all of the money themed blockchains and smart contract blockchains. So, in another episode, I talked about how in my time in crypto, I've seen lots of blockchain come and go. Most of them are still out there. We refer to them as ghost chains. Most of those chains were all iterations of Bitcoin that did the same thing that Bitcoin did, but cheaper or faster. And so you can think of lots of chains like this. I've made mention of Feathercoin, Clark Coin, some other ones that do this, Stellar Chain, which is more of a public chain rather than a private chain like XRP. All of these chains, what they have in common is that they do what Bitcoin does. It is a money ledger. That is the purpose of the blockchain. And I don't want to downplay the importance of this. A money ledger is revolutionary. A decentralized money ledger is revolutionary. The money ledger was also revolutionary, but the decentralized money ledger is very revolutionary. However, what I want to point out is that Ethereum and the smart contract blockchains, they are money ledgers, but they also are meaningfully different from blockchains that are just money ledgers. So sometimes I hear talked about in CNBC or other places where folks typically don't really understand crypto very well, is that Bitcoin is kind of like gold. If you were to refer to these things as commodities, Bitcoin is kind of like gold, and Ethereum is kind of like silver, like a little brother to Bitcoin. But that's just not the case. They are meaningfully different blockchains. And I'm going to try in this episode to help you understand how significantly different they are and why they are both important. So, if you're listening to this podcast, I assume that you already understand Bitcoin at some sort of basic level. You understand its importance as a decentralized form of store of value or money, a digital gold, right? A government agnostic store of wealth. All right, whether you want to call it a money or a currency, I think you understand. I'm hoping you understand the technology. Now, this particular episode is going to be a rather low level. I'm going to call this an introduction level to to crypto technology here, um, because you're not going to understand it all. But I do think it's important that everybody understand that Ethereum and Bitcoin are meaningfully different. And I'm using Bitcoin and Ethereum as proxies. Really, what I'm talking about is the money blockchain versus the smart contract blockchain. All right. So let's go back to the commodities analogy. I do think that it's a good analogy to think of Bitcoin as a digital gold. I think that that's a fair analogy. It's has all the similar attributes that give gold value, plus some bonus attributes, such as the ease of storage and the ability to uh, transact over vast distances, right? Gold, it's really hard to buy things online with gold. It's very hard to send gold to your family in Colombia. It it's just it was a great technology at the time, but it's an outdated technology. So after Bitcoin, there was all these other chains that I've mentioned, Stellar, XRP, the Nano. Please forgive me, I don't study all of these chains in depth. There's just too many chains out there. But in general, these are all chains that do the same thing that Bitcoin does, but with some minor alterations, usually to the speed or to the transaction costs, which are important. I don't want to downplay that. I like low fees and speed. What I didn't understand when Ethereum came out is that it is meaningfully different in what it does, right? So I was around when Ethereum had its ICO. I had the opportunity to buy Ethereum at, I believe, 13 cents, but I didn't understand that it didn't just do what Bitcoin did. And so I opted to not buy Ethereum at 13 cents. Um, I didn't buy Ethereum until much later when I actually understood what it did. So let's go back to this commodities analogy. If we're going to use a commodities analogy, I don't think that it's a good analogy to think of Bitcoin as gold and Ethereum as silver. And that's because Ethereum, though it works as money, it can work as a currency. That's not really what it is. If I were to compare it to a commodity, I would compare it more to something like oil. Ethereum as a coin, or the cryptocurrency Ethereum, is there to power transactions on the Ethereum network. And the Ethereum network is more than just a money ledger. The Ethereum network is a programmable blockchain. So let me break down what this means in practice. For Bitcoin, it works great as a ledger. If you send Bitcoin from person A to person B, it records it. If person B sends Bitcoin to person C, it records it, and it keeps track with 100% accuracy the amount of Bitcoin that each wallet contains. And it does that flawlessly, always has. Ethereum doesn't it keeps track of the transactions, but it also keeps track of computer code. The code on Ethereum is written in Solidity. That is one of my specialties. A programmer, a developer, can write a code and submit it to the Ethereum blockchain, where it is immortalized with its own address. Now, just like a transaction on the Bitcoin blockchain is immortalized, the code that's submitted becomes immortalized on the blockchain with its own address. Other transactions can then point to that address, and it will run the code that is associated with it. Now, why this is interesting is because now you can do very, very complex transactions. Now, this means that not only can it keep track of money, but it can do all the other things that the financial system does. Sometimes better, sometimes not as well. But what it can guarantee is that every time that code is called, if all the parameters are met, that code will be run and the outcome will be immortalized on the blockchain. So this means that it can handle and not only money, but an entire financial system. Now, whether it can handle it or not is up for debate because the Ethereum blockchain itself, in particular, is not fast enough to handle all the transactions that might occur in a financial system. Not even close. No question, not even close. However, it's got the seeds for it, right? All the other smart contract blockchains that exist do the same thing as Ethereum, but have some mechanism to do it faster or less expensive, or have other minor tweaks around the edges that don't make them meaningfully different. They don't do something different in the way that Ethereum does something different than Bitcoin, but they do the same thing as Ethereum. They do it faster or cheaper or using a different consensus mechanism or using a variety of different types of chains or mechanisms or consensus patterns or something like that. But the thing they do is similar to Ethereum. And what that means is that the Ethereum network can not only host Ethereum, that is its native token, it can host other types of money currencies, but as well as storing all sorts of other types of value and as well as things that do not contain value. Right? So most tokens, if you ever go to CoinList, if you get past the first 10 or 20 tokens on that list, or I should say, let's delineate here between what is a token and what is a coin. There's not an entire consensus here. Typically, when I'm going to say Ethereum or native currency, Ethereum is the native currency of the Ethereum network. It is the only thing on the Ethereum network that can be used to pay for transactions on the network. Everything else that exists on the Ethereum network is considered a token of some sort. So NFTs are non-fungible tokens. Most other tokens you might be familiar with, USDC, Tether, Aave, Uniswap token. These are all what are referred to as ERC20 tokens. All of those tokens exist on the Ethereum blockchain. To transact in those tokens, you need to use Ethereum. And this is why I refer to Ethereum more as oil than as a money. Rather than referring to it as a commodity like gold, I refer to it as a commodity like oil, because Ethereum is the fuel that powers the transactions on the Ethereum network. In fact, when you pay for a transaction on the Ethereum network, it's referred to not as a transaction fee, but as a gas fee. And the more complex the transaction, the more that you will spend in gas to make that transaction go through. So this is going to simplify kind of how Ethereum works under the hood. It's going to oversimplify it. But again, this is really so that more beginner crypto users can understand the difference between smart contract chains and the money chains. You can link together multiple smart contracts. So smart contracts, again, are a bit of code that has been immortalized onto the blockchain. And if you've ever heard somebody refer to perhaps money Legos, it's because you can link together 2, 3, dozens, hundreds of these smart contracts to make very elaborate transactions occur. It's fascinating to me, partially because I write smart contracts, but it is enabling all sorts of financial products and things that are not available in the traditional finance world, because you just can't do these types of things without layering up lots of different types of transactions. So the real difference here is that Ethereum is more of a computer. It is more programmable. More things are possible on Ethereum. It does all the things that Bitcoin does, but it does all the other things also. So let's think of a practical use. Imagine that you have Bitcoin, right? Some folks are believers only in Bitcoin, are Bitcoin evangelists. And so imagine you have Bitcoin and it's nicely decentralized. You've got it in a self-storage wallet because you know what you're doing. Now, imagine you want some liquidity from your Bitcoin. You don't necessarily want to sell it for tax purposes or because you think it's going to appreciate or for whatever reason. You don't want to sell your Bitcoin. Imagine you need liquidity. If you need liquidity from your Bitcoin, you're going to have to take it to some centralized institution who's going to give you some liquidity, right? Again, introducing these centralized institutions back into the picture. On Ethereum, you have Ethereum and you need liquidity. You lock it into a lending protocol, a smart contract that says, we're going to hold your Ethereum and pay you in stablecoins, or perhaps you wanted to borrow Uniswap tokens or something. You want to short Uniswap tokens or something. You can go to a protocol, borrow those tokens in a decentralized fashion. Some protocols are more decentralized than others, but that is a topic for, it's a more advanced topic for later on down the road. Hey, blockheads, thanks for listening. We're going to get you back to the podcast in just a minute, but before we do, there's something I want to share with you. I believe that if crypto is going to succeed, what it needs is fewer speculators and more knowledgeable users. That's why my mission is to take the crypto curious and empower them to become confident, competent crypto users. So if you're like me and you believe that crypto has a role in the future beyond speculation, I invite you to join the Blockhead community. All you have to do is visit blockhead.finance and join our mailing list. Optionally, if you have a self-custody Polygon address with at least 5 Matic in it, you qualify for our Blockhead airdrop. That's right. Just put in your Polygon address and we will airdrop you some useless DUH tokens. Let us know what topic you want us to cover next, and we will double your useless tokens. Don't have a Polygon address? You are in luck. We've included a short video about how to set one up. So join us at blockhead.finance, and congratulations on being amongst the brightest of crypto early adopters. Now, back to the podcast. You can actually, as it turns out, you can actually borrow against Bitcoin in a way on the Ethereum blockchain. Something to remember is that Bitcoin on the Ethereum blockchain is not Bitcoin. It is a Bitcoin derivative. But there is such a thing on the Ethereum blockchain as wrapped Bitcoin that trades as long as everything's going well, that trades at the same market price as Bitcoin. But what you've really got is an ERC20 token that represents Bitcoin held on the Ethereum blockchain. And this is a key thing to understand too, because what we've got here is tokenization on the Ethereum blockchain of an asset that is not on the Ethereum blockchain. So one really cool thing, and the kinks have not been worked out of this entirely, but if you can do this with Bitcoin, you can do this with all sorts of assets. So these smart contract chains, though, as far as I can tell, none of them can actually handle the actual volume of something like a NASDAQ or a New York Stock Exchange. If you could tokenize equities, you could tokenize equities onto a smart contract chain. Instead of issuing stock, companies could issue a token. And they can actually even pre-program it so that it has certain rules around it if they wanted to. And it can be issued onto a smart contract blockchain. Then those tokens can be used in all sorts of fancy financial transactions without intermediaries. So this is really starting to drag on, and there's no way that I can cover, there's no way I could possibly cover in a month all the things that are possible to do on the Ethereum blockchain. It's very complex, and there are thousands and thousands of different types of transactions you can do. I myself have created dozens of different types of transactions, smart contracts on the Ethereum blockchain that interact with other smart contracts on the Ethereum blockchain. But the important thing to understand here is that Ethereum is more like oil, as the point of Ethereum is to process transactions on the Ethereum blockchain. Okay? It works as money. Anything can work as money. Salt can work as money. Shells can work as money. Polished rocks can work as money. Ethereum can work as money, but it's, as a commodity, it is the fuel that powers transactions on the Ethereum blockchain. And that is important because there's all sorts of transactions going on the Ethereum blockchain at any given time. That happens to be why it's expensive, is because there's a lot of demand for block space on the Ethereum blockchain. The less demand there is, the less expensive it is. The more demand, the more expensive it is. So I hope that cleared things up for you. I hope that at a base level, you understand that Bitcoin is digital gold. Ethereum is something entirely different. It is a digital financial system, or it's the network, the platform that enables a digital financial system. The blockchain is the token, the ETH token is the fuel that makes those transactions happen. And because it is the fuel that makes those transactions happen, it has value because you cannot pay for transactions to happen on the Ethereum blockchain with Bitcoin, with dollars, with USDC tokens. You can only pay for transactions with Ethereum. So it does get much more complex than that, but I just wanted listeners to have a base level understanding of why Ethereum is meaningfully different than Bitcoin in a way that things like Stellar or Litecoin are not. Now, when you're looking at the market cap of different cryptos, you will see that there's lots of other smart contract platforms, or there's lots of tokens or coins that are going to be more similar to Ethereum and things that are going to be more similar to Bitcoin. So things like Avalanche or Polkadot or Cosmos or Phantom, all of these are do the same thing as Ethereum, but have some thing that differentiates them. Usually it's speed or price are important. They don't actually do anything meaningfully different other than speed or price or some kind of fancy consensus mechanism. But they all do something meaningfully different from what Bitcoin does. I hope you understand that. I hope you're safe out there. I hope if you are investing in cryptocurrency that you know what you're talking about. I hope you know what you're investing in, because if you don't understand it, you have no business investing in it.